There's been a spate of economic data released a short while ago, including retail sales, the current account deficit, and of course, also the growth prospects for the country. Joining us now, George Glynos, MD at ETM. George, thanks so much for joining us today. Apart from all the economic data, looking at the rand, 6.99 to the US dollar. This time last year, you were talking about the rand going to 6.50 at a time where some international banks were alluding to the rand heading to around 10.20 to the US dollar. So obviously, you've called it right.
Thankfully, so far, look, we're not at 6.50 yet, but we're headed in that direction. We're still fairly comfortable with our interpretation of events as they lie at the moment. So we're quite pleased with the call so far, and we're hoping that our interpretation holds true for the rest of the move. But again, it's largely driven by offshore factors. I think too much of the time we put too much emphasis on what happens domestically as a driver of the currency, and in this instance it's been very much a case of offshore structural features have driven the rand to these levels. They remain in place, so we believe that the appreciative rand factors that have driven the rand so far could very well drive it a little bit further.
Well, sure, of course, offshore factors driving the rand, but some of the internal factors must also be contributing. So we looked at that current account deficit, 2.5% of GDP, and that's quite positive. So some of those positive factors locally must be helping to draw that foreign capital into our markets.
To some degree, we've always held the view that we think too much emphasis is placed on the current account. It's important at that point in time when it becomes marginal, when the funding of that deficit becomes marginal. But we haven't had that problem for quite some time. And as we saw from today's numbers, at 2.5%, it really is not very difficult, especially when you've got all the policies that have been implemented abroad that make South Africa look so much more attractive. It just becomes that much easier to finance that current account deficit. So focusing on the current account deficit as a negative, as a net negative, tends to draw you down the wrong road. And I think overall, yes, it's a contributing factor, but in and of itself, it's not a rand positive factor.
Well, at a time where the rand is strengthening quite extensively, and we keep talking about how it's going to be impacting the manufacturing and the export market, we have seen exports increasing by 6.4% in value terms in the second quarter. We're seeing more demand coming through for South African products from China and from India. Imports up just slightly, George, and it's at a time where the IMF is saying that the rand is overvalued by between 5 and 15%.
Yeah. Insofar as this rand being overvalued, the market dictates where the rand's going to be. The rand's going to be where the flows dictate the rand is going to be. And as far as I'm concerned, I'm not quite sure what sort of argument you hold to evaluate whether it's over or undervalued by a few percent here and there. To our mind, though, you touched on some very important features there. That exports have remained buoyant, that the trade account has moved into a surplus type position. That exports have remained buoyant hasn't really been as a result of huge productive capacity in South Africa as much as it's been through commodity prices remaining buoyant. And those buoyant commodity prices, especially when most of those commodities are headed towards the likes of China and India, and when South Africa is focusing its attentions on China and India, I think is a very positive thing. And it gives us insight into potentially what may be in store for the future. So if we believe that the depreciative currency policies that have been implemented abroad have played a key role in boosting commodity prices, and that they're likely to continue doing so going forward in the future, and if you believe that the demand from the likes of China and India are going to remain robust, well then you must also hold the view that if you want to focus on the current account, that the current account is going to be narrower and easier to finance. And of course, when you've got the kind of bond inflows that we've got at the moment, it almost makes it a certainty that the rand remains very strong.
You said, George, it's difficult to say whether the rand is undervalued or overvalued because the market's going to decide that. We had the ANC General Secretary yesterday, Gwedi Mantashe, saying that the ANC wanted a competitive rand, not a weak rand. And that to me sounded quite positive, that he's not asking for the rand to be much weaker. He's asking for it to be competitive. It's a value that benefits the entire economy. Do you think we have a competitive rand at 7?
Whether or not you've got a competitive currency relates more to how productive your economy is than the actual level itself. I think far too often we sit and focus on a specific level that might benefit here and benefit there. But the reality is it's how productive you are. And if you are very productive, you can do with a currency that's far, far stronger. If you're less productive, naturally you need the rand weaker. At this point in time, I think the calls for a weaker rand are born out of the realization that South Africa as an economy is not particularly productive and needs to do more on that front. But there are other factors that come into that whole equation as well, which make it a difficult argument. But I think overall, to try and peg that number is near impossible. That it must be competitive. Of course, everybody wants that. I mean, at the moment, we've got a race to the bottom with the major currencies. Everybody wants their currency weaker. Why? Because it will help promote some of their exports, of course. But it's if you want to follow that path, then naturally you've got to follow depreciative currency policies, which ultimately make your economy poorer, not wealthier. So there are offsetting considerations that I think people need to think about before they just call for a weaker rand or call for a stronger rand.
George, I'm glad you touched on productivity, because that is the key issue right now in South Africa. We've got the NGC meeting currently underway. We've heard things such as the NHI come to the fore. Fortunately, no real movements coming through on policy going forward, and nationalisation apparently not really on the agenda either. Do you think productivity is going to be discussed at the level that most business people would like to see? Because at the end of the day, that is what we need to discuss if we are going to start being competitive on a global level.
Sure, and core to that productivity is, of course, labour. So labour has to get more involved with that discussion as well. And front page of the Business Day today had the IMF calling for more labour reforms. They wanted more flexibility in the labour market, and we would wholeheartedly agree with that. We can't be held over a barrel by unions and still expect to be competitive versus a number of international economies that perhaps don't have to deal with those constraints. So it might not be a very popular view that I hold, and it might be more of a free market view that I hold. Ultimately, it does come down to productivity, and productivity in part is related to how flexible or inflexible your labour market is. At this point in time, I would hasten to add that South Africa's labour market is not particularly flexible at all, and it's a constraint for business. There's no question.
Because the IMF also said that the rand at current levels was hindering economic growth in the country, although it did upgrade its growth forecast to 3.2% for the year. So it seems to be playing it both ways at this stage.
Yeah, it does. But again, one needs to look at it in context. I think there was a great piece of research put out recently by Dr. Adrian Saville, where he spoke about the correlation, in fact, between a strong rand and economic growth. And what you tend to find is that a strong rand tends to correlate with strong economic growth in South Africa. And the basic driver of that had less to do with the exact value of the rand and more to do with the kind of growth that's being experienced globally and how that translates into growth in South Africa. And I think really that's where the productivity argument kicks in, is that you need that productivity to be able to take advantage of a weaker rand when it comes about to help offset perhaps weaker growth abroad. That's where that argument holds a lot of value and holds truth. But in and of itself, I think we need to be a little bit careful about arguing, for a weaker rand, for a stronger rand, the same old arguments that we've heard 100 times.
Right, let's take a look at what Mondi Nyandi, advisor to the governor and chief economist, had to say about the current account deficit.
The second quarter of 2010, travel receipts from non-residents associated with the sport event amounted to roughly 3.5 billion rand. Annualized, this comes to about 15 billion rand. This raised travel receipts by almost 26% from the first to the second quarter of the year. May also be pointed out that the tournament had a quite limited impact on the demand for notes and coin, an experience shared with other countries hosting major sport events in recent years.
George, the World Cup effect, relatively evident, and many people were really sort of skeptical about how much money would flow into the country. In the second quarter, we saw 15 billion rand spent by foreigners. So clearly that also impacting our retail sales number, which was revealed today, 7.9% growth in July.
Sure. Yeah. And there's more to that. In fact, if you look at some of the breakdown, you look at just the private sector credit extension numbers and use of credit cards and whatnot, you'll see that the use of credit cards has actually not been rampant. It's been there and it's been positive, growing, but not rampant. Equally, you find that the PSCE numbers have been positive for sure, but not rampant, all of which would suggest that much of the growth in the retail sales has been more on cash sales than it has necessarily been on credit card sales, and that in and of itself would support the view that there must have been some benefits received from the retailers from foreigners coming in with cash money to go and spend in the shop. So I think that was certainly a positive, but we saw some big ticket items, electronic goods and whatnot benefiting from the World Cup too. But again, Eleni, I think one needs to just bear in mind that's likely to be a temporary effect. If we want to get excited about retail sales, we need to see these sort of growth rates extend well into the second half of this year. Then we can sort of start turning around talking about the consumers back, the consumers.
Yeah, and the household debt to income ratio did come down slightly, 78.2% from 78.7%. In the right direction, but clearly not a strong enough move.
Not a strong enough move. So generally, you'd want to see more of a deleveraging on the household to put it back in a fundamentally strong position. But on a more positive note, you'll see that the disposable income for the past 2 quarters has turned positive and meaningfully positive. Naturally, it is off a low base, so we accept that, but it would suggest that employment is starting to kick in. It also would suggest that the low interest rates are having an effect, and the higher wages that have been secured by the unions are all playing a role in helping restore some of the disposable income of households. So that in and of itself is going to help bring and reduce that ratio a little bit further. But there's no question that it probably needs to reduce by as much as another 5 to 10% before we could be happy that it's a fundamentally sound level of which really good growth could be expected in the future.
Average CPI expectations for next year have eased from 6.5% to 6.1%, and that's according to the Bureau for Economic Research's latest inflation expectations survey released earlier. Nkanyiso Hlongwa, an economist at the BER, joins us now from Cape Town. Nkanyiso, thanks very much for coming on to the show today. Well, what is interesting is that, and it's something that carries through from the previous inflation expectations survey, is that business and unions are a lot more pessimistic on inflation expectations going forward than economists themselves.
Yes, no, that has been the general trend over the years, is that the expectations of the business and the labor have been higher than those of the analysts. So it's not surprising that we see it continuing again, but as the biggest surprise is that they have lowered over the forecast period, which is something that we had not seen significantly in the first 2 quarters, but it's definitely come through in this quarter.
George, average inflation expectations for next year 6.1%. We have the economists, though, expecting it at 5.2%. And that would really fit in with what we've heard from the Reserve Bank as well, that we are going to be within this target range for next year and possibly into 2012 as well. What are your expectations there?
Well, our expectations are substantially lower than that. Whilst we expect inflation to tick up moderately through the second half of this year, we're actually anticipating inflation drops towards the lower limit of the 3 to 6%
helped, of course, by
band.
the strong rand.
Helped partly by the strong rand, but also partly because of some of the structural features of the global and domestic economies and how they interact. And I think the combination of that together, for sure, we believe that inflation is still being overestimated and that we could easily go back towards the 3% mark, perhaps in the extreme case even go below that level.
Nkanyiso, well, just taking a look at some of the numbers that have come to the fore. Financial analysts for this year, 4.5% inflation is what they're targeting. Business is talking about 6.5%. Trade unions talking about 6.2%. And interesting to note that at the beginning of next year, perhaps will be just above the target band of just over 6%. And according to most of the people out there that you've surveyed, except for financial analysts that are talking about 5.2%. Just looking at the global scenario, how is that also going to impact South African inflation expectations and, of course, the thoughts on that? Because, of course, we keep seeing revised numbers often.
Well, the important thing to realize is that with the analysts, in terms of some of the information that they use in making their inflation forecast, they consider things like base effects, and they have a much more in-depth knowledge of the industry as is. Some of the business managers and the labor unions have based some of the expectations not exactly on where things stand, but in terms of what they foresee things like the labor wages going up by and costs in terms of the business side. So with the global story continuing and the strong rand, we do see the impact via business managers who've lowered their inflation expectations. And I think the continuous trend of lower inflation, lower oil prices as well globally, have contributed to the labor unions and the business analysts decreasing their expectations in the latest survey.
Nkanyiso, you look at 4 social groups in this survey. Do you think that different social groups actually feel inflation at different levels, and that's perhaps why we're getting these variances through here?
Yes, indeed, we do feel that. The heuristics that the different social groups would use are different. For example, the household survey would look more at what they expect in terms of the wage increases, whereas the businesses might be looking at costs as a measure of their inflation, and those would impact on where they'd each see inflation over the forecast period.
So just touching on the interest rate cycle, of course, we have been hearing that the interest rate cycle is not really going to move anywhere from here onwards. We might see another cut. What are you seeing right now on the ground? What are people talking about?
Well, in terms of interest rates, if you look at the survey results as well, a lot of the respondents have decreased their expectation. A lot of them are looking at 10% in terms of the prime rate, and some of them 10.5% in 2011. But that's besides what the Bureau is looking at, and we've seen the interest rates have sort of reached their limit in terms of declines, and they'll only start picking up next year. This is the same trend we also see in the results, is that the prime rate for next year is higher than what it is for this year, which shows that some of the respondents are actually seeing interest rates picking up next year, and some of them even later than that in 2012.
George, what's your view on that? Because if you expect inflation to continue retreating, perhaps going to the lower edge of the target, would you expect more interest rate cuts rather than increases going into the future?
Yeah, we're looking for at least another 1, possibly 2 interest rate cuts going forward. Again, it's not consensus, but that's fine. We still believe that the interpretation that we've got on the global economy is such that it's going to produce asset price inflation and goods and services deflation or disinflation to the extent that it will offer the Reserve Bank the kind of flexibility and maneuvering space with which to reduce interest rates and offer more monetary accommodation.